The Iran war, economy, and rates. This is all right. So go ahead, Rick. Take over. These are your slides. Oil prices.
Yeah, we were talking about market momentum at the end of 2025 and how we were all hopeful for 2026. And then
Yeah.
we got a 1-2 punch in the first quarter. The first one was Mother Nature. So weather just slapped us right in the face in January and February. And then the bombs started to go off in Iran. So it really throttled the momentum we'd been building. The reality, though, is if you look at the first 3 weeks in January, the first 3 weeks in February, we were actually outperforming last year in terms
We
of home
were.
sales.
Yeah.
That weather that hit the Midwest and the Northeast just killed home
Mhm.
sales the last part of both of those months. And then, of course, we had the war start in Iran. That jacked oil prices up significantly. This was just a snapshot in time when I put this slide in place. We've had oil prices actually go up as high as $120 a barrel before they started to come back down to more reasonable numbers, semi-reasonable numbers. And the ongoing blockade of the Strait of Hormuz is unsettling the oil markets. We're not sure exactly how high or how long these prices last. And that kind of concerned the bond market. So we started to see bond yields go up. And when bond yields go up, guess what? Mortgage rates go up. So we went from having a lot of pent up demand hitting the market in terms of people applying for mortgages to that kind of drying up in March. We saw inflation go up from 2.6% annual growth the month before to 3.3%. If you have even a rudimentary understanding of how to read a bar chart, you can probably figure out that big black bar there is what drove inflation up. That's energy prices, that's gas prices. And the irony there, of course, is until this war started, energy prices have been bringing inflation down. They were lower year over year. Let's keep this in perspective, though. I like to do that in historical context.
Yeah.
3.3% rate of inflation is not what the Fed wants with its 2% rate of inflation. But historically, on average, the US rate of inflation is somewhere between 3.5 and 3.6%. So we're still below historically high averages of inflation. And the hope is if oil prices do settle down, that these inflation rates will settle down as well.
Papa Den and Nona, so you guys can concur. You were seeing, talking to agents across the country, seeing things were warming up nicely, metaphorically speaking, because it was so darn cold in the Midwest, but things were warming up. So what were you seeing out there?
I'm starting to see more and more agents, they've been stuck. They've really been frozen in their tracks, as we talked about in December. But to your point, Rick, I started seeing some agents now getting unstuck, but the month of April has been starting to open up a little bit. I think everybody's just tired of being stuck. I really do. I think they're just like, I need to do something. I'm staying in real estate. My bills keep coming. I need to start making something happen. So that's what we're starting to see. More and more agents are reaching out, wanting to do our remodeling course, because everything we're talking about with the remodeling world, homes need work. People are like, tell me what I can do. How can I help you today? So more and more are recognizing I just got to get with my sphere, start seeing what's going on with them, and seeing if I can get them into something else that maybe makes more sense for them. That's what I'm seeing a lot of.
That's a great point. I think psychologically, the other thing that we're hearing as we're talking to folks is that home buyers or prospective home buyers are starting to reset a little bit in their mind what their expectations are. So back when we talked last, you could still easily say, and again, I don't know who can measure statistics on it, but could easily say the majority of home buyers still had this dream of that move-in ready, pretty as a picture home. What we're starting to hear, and it's particularly in the younger buyers, where they're coming to that realization that if we're going to buy a home at all, it's very unlikely it's going to be a move-in ready. Maybe here or there's a builder bringing an entry-level product to the market, but there's some tremendous compromise. If we're going to buy a home, we're going to have to accept the fact that it's going to need some love, it's going to need some fixing up. And I think to Teresa's point, that's why we're hearing more agents who are also realizing as they listen that they need to have those skills to help people through that process. And we think we've banked a lot of our efforts on the fact that as we continue, that's going to become more and more a part of the world of real estate. There's pent up equity or equity you can anticipate through that effort. It's going to help people move into housing who would not be able to otherwise. So we're starting to hear that shift, and we think that bodes well to getting product moving. And the last thing I'll just mention, I don't want to forget, Rick nailed it earlier when he just mentioned about the fact that with inventory, we hear different stories about inventory in different markets, but the reality is in most markets, in spite of the numbers, a lot of that inventory is just not inventory people are interested in. It doesn't really meet their needs.
And if I may add one other thing too, the other thing I'm hearing, especially like in the last couple of months, the sellers are now starting to hear more and more from the agents. You're not going to make what people made on the houses 3-4 years ago.
Yeah,
so
great point.
what's going on in your world? You're just going to have to accept the fact that you missed out on that opportunity. And now let's just move forward. That's the one thing that more and more agents are starting to be more assertive about it and just more real about with sellers just coming to market that way.
Good point.
Yeah. And Rick, how does the job growth and wage growth factor into this and general confidence?
Yeah, the basic economic criteria that I look at to guess where the housing market is going is jobs. And if we're creating jobs, if wages are growing, that tends to mean you're going to have a decent housing market, whether it's owner occupied or multifamily. And we did see jobs recover a little bit in March, which was a good thing. Fell off a cliff in February, mostly because there were some big strikes going on in the healthcare industry. And healthcare was where we were getting a lot of our job growth over the last year. We had another big drop. That was because that was when literally hundreds of thousands of federal government employees had their severance package expire after accepting an early retirement package in January. So that one is one we probably should have seen coming. But wage growth at 3.5% year over year in March, even though it's a little lower than it had been in February, was still higher than the rate of inflation, still higher than what we're seeing in terms of home price appreciation. So affordability is not great in the housing market, but it's gradually getting a little bit better. And I think to the points that Dennis and Tree were making a couple minutes ago, and I think we talked about this in December, I think we're at an inflection point in the market. I think we were looking at about a 3 to 5 year reset period after prices went up by 40%, then mortgage rates doubled in the middle of 2022. Everybody was in sticker shock, and it was going to take the market a while to recover from that. And it felt to me like at the end of last year, we were finally starting to see that movement. And I was expecting 2026 to be a transitional year where things would gradually get better and lead to a more robust 2027. And maybe if we survive that first quarter and things do start to pick up a little bit, and I'm seeing some green shoots out there as well, maybe we still end up this year but with a better year than we had a year ago.
It's possible. I agree that because it started so well and mortgage interest rates actually got below 6%, that psychological barrier, just as we were ending February, and then the bombs dropped and went up to about 6.5. And now it's around bouncing between 6 and 6.5. So people are still out there shopping. They're very sensitive to gas prices and what they're hearing in the news. Like I just saw today that mortgage applications dropped. But like your slide says here, rates are down in many cases year over year, lower.
Yeah, we're even with rates being at 6.3, 6.4%,
Yeah,
they're about 3/4 of a point lower than they were a year ago. And that's meaningful.
it is.
It doesn't make everything affordable for everybody, but it makes more homes more affordable for more people.
With wages going up, and we'll talk about that in affordability, wages going up, interest rates coming down, prices staying low, it's going to fix things. Consumer sentiment and confidence, obviously, because of what's going on in the news, it's not helping. Fill us in on this slide.
Interesting, the consumer sentiment index hit an all-time low. That's the chart on the left. And
Yeah.
interestingly, I just read today that the most recent report that came in, it ticked up a little bit, which was a surprise. Consumer sentiment covers things like cost of living. How affordable is my rent or my mortgage payment? How affordable is groceries and gasoline? And so with that and the fact that there's a war going on, not a big surprise that consumer sentiment isn't doing particularly well. Consumer confidence has been trending a little bit better. And what that measures generally is people's sense of confidence in whether or not their job is stable. Am I going to be able to keep my job or not? If I'm looking, am I going to find another one? One is about cost of living. The other is about the job market. And that one's been doing a little bit better. Neither of them are breaking any records for positivity. And consumer uncertainty does have a tendency to slow down decision-making on big financial purchases like buying a house. but we'll have to see how this all plays out in the months ahead.
Yeah, this is going to, next couple of weeks or month, a lot of things can change. Last slide here related to the economy, but we've got consumer debt at an all-time high, delinquencies rising. Thoughts on this? Is this, are there any bells, red bells or warning bells in this, Rick?
Oh, of course there are, but there's also a way to mitigate this a little bit. So yeah, consumer debt, all-time record, $18.8 trillion. And that probably is one of the reasons for consumer sentiment being what it is. But about 70% of that, about 13 trillion, is mortgage debt. And that's offset by about $36 trillion in homeowner equity. So that's considered relatively safe. And of all of the types of consumer credit, that's the one that's performing best in terms of delinquencies. So people are paying their mortgages on time. That said, we have a record level of student loan debt, about 1.65 trillion. We have about 1.6 trillion of auto loan debt. We have about 1.3 trillion of credit card debt at a time when the average interest rate on a credit card is somewhere between 25 and 30%.
Holy cow.
Yeah, if you're fortunate enough to have that Macy's charge that you take out at Christmas and use once a year, make sure you have it paid off, because that's coming in at a nice 39% interest rate.
Oh my gosh. I'm glad I don't have that card. Woo.
That used to be a rate that would get you arrested for usury, or
I
that
was going to ask that.
was only available from my cousin Vinny back on the docks in Philadelphia. And now apparently it's the new normal. But the fact that people are using their credit cards as much as they are, the fact that savings rates have gone down as they have, suggests that perhaps the cost of living is high enough that people are struggling to make ends meet. And so we're watching those pretty closely. Those delinquencies you talked about, Christian, are, a lot of economists believe this is just a reversion to the mean, that we're getting back to levels of delinquency we saw prior to the pandemic.
I
and
see
that those lower levels that we saw, that the big spike you see there is the Great Recession. If you go just before it starts to dip, that was right before the pandemic hit. And a lot of people actually use those government stimulus checks to pay down their debt. So delinquencies did come down pretty significantly when the government was sending everybody checks. But it is something to watch. And the student loan debt is one that might have an impact on housing.
Yeah, we're going to talk about that. We're going to race through the FHA perfect storm, because you talk about the student loan debt there. And this is something I've been talking about on my channel related to when I do my foreclosure updates. Southern California foreclosure update is really, in a nutshell, FHA loans are driving a big portion of the delinquencies. And there's an irony in there, and that is these tend to be homes that are going to be for first-time home buyers in many cases. So there's going to potentially some first-time home buyers can lose their homes, and then a whole new crop of first-time home buyers will get homes. So a sad way to look at it. But, and then when you guys were all talking about remodeling and homes not being up to snuff for buyers, in some cases, not intentionally, but some of these FHA buyers, maybe they didn't get a chance to fix them up while they had them and they're losing them, or they've had to let certain things go, can't take care of major repairs because they just don't have the funds to do it. So Rick, I'll let you jump in. Here's the student loan delinquencies.
Yeah, there's about 5.5 million seriously delinquent student loans right now, with another 4 million that are in early stages of delinquency, 4.3 million. So we could be looking at almost 10 million student loans being seriously delinquent in the coming months. A very high concentration of those loans happen to be in the Southeast, the southeastern states. We're going to talk a little bit more about that region in a couple slides, but that's something to keep in mind for a couple of reasons. One is we have a lower home ownership rate among people with student loans than people that don't have student loans. A lot of times they're waiting to get the student loans paid off, or their debt to income ratio is too high because of their student loan payments. The other thing that's true is that we have a higher delinquency rate for people that have mortgages who also have a student loan than people with mortgages who don't have a student loan. And the government can start garnishing wages once somebody is 10 months delinquent on a student loan. It hasn't happened in large numbers yet, but if it does start to happen, that wage garnishment is going to be about $700 to $800 a month. And that's a big number for somebody who's already probably struggling a little bit with their monthly bills. So that could have an impact on delinquency rates, on default rates, and on home sales rates.
That's a fascinating correlation. And it's also, in a twisted sense, it's easier to get rid of mortgage debt
It is.
than it is to get rid of student loan debt.
Yeah, it's almost impossible to get rid of student loan debt.
And they're still charging high interest rates on it. I know because I got a bunch of kids in college. PD and Nona know they've got grandkids. So we'll just buzz through this. So we have more properties entering the 30-day delinquency. That's it. The important thing to remember with foreclosures is they can't sneak up on you. You can't suddenly have 100,000 bank-owned homes just show up at the auction steps. It's a process. So California, 120 days after missing a payment, you get the notice of default, 90 days notice of sale, 21 days later, the sale. It's very rare it's that fast. Usually it's 700 or 800 or 900 days. So point is, once you start to see an increase in the beginning, you got to keep tracking to see if they continue to flush out to the end. So we're starting to see the starts go up and the auctions at their highest level in 5 years. Now, a few of those last 5 years were foreclosure moratoria. So we were down, but it's definitely a trackable number. And for investors who are looking to buy, you should be tracking foreclosures right now.
If you go back to 2019, right before the pandemic was declared, there were 191,000 foreclosure auctions over the course of the year. Last year, there were 84,000. Even though we're at the highest level we've been since then, we're still running at less than half of where we were in a more normal year. So it takes time. But foreclosure starts are almost back to the numbers they were at in 20. And we are seeing more loans roll from serious delinquency into foreclosure now because some of the guardrails have been removed.
Yeah, they were important. Due to COVID, they had mortgage forbearance programs. Those expired for VA. They expired for conventional loans a while back. VA and FHA were last. FHA expired end of September, I believe. So Q4 of 2025, those protections were gone for FHA lenders or FHA loan holders.
So right now, about 12% of FHA loans are delinquent. About half of all seriously delinquent loans are FHA. So about 875,000 delinquent FHA loans in the pipeline right now. And to your point, their loss mitigation protocols switched in October to make it harder for people to stay out of delinquency once they're in because they were using a loophole in the system. Are you going to be talking about the other FHA attributes in the Southeast as we get through this, or should we really quickly touch on it now?
I think I pulled it out. Do it.
So if you're looking for where we might see foreclosure activity, it's going to be states with a high concentration of FHA loans. And if you drew a smile across the bottom part of the country from Phoenix and Las Vegas along the south through Florida,
I see it. Yeah.
That's where you have the highest concentration of FHA loans. We're also seeing the highest concentration of delinquent student loans. If you layered on top of that, which states had the highest increases in insurance premiums and property taxes? It's the same states.
Oh,
and if you also layer on top of that, which states have had price declines year over year in home prices? It's the same states. So if you're an FHA borrower who took out a loan 2 years ago with a 3.5% down payment, or a VA borrower who took it out with a 0% down payment, and you're in Austin where home prices have gone down 10% in 2 years, you're now underwater effectively. And guess what? Your insurance premiums probably went up $200 a month. So you're paying more out of pocket than you thought you were going to. And it's a layering effect that suggests we're going to have a little bit of fallout in those states from FHA borrowers over the next couple of years.
Wow.
And that's opportunity. Unfortunately, it's someone else's loss. And like you were saying there, PD and Nona, those will be houses to fix up. So we're getting close to the end. This is fascinating stuff. And by the way, what you just shared, Rick, that lovely layer cake of awfulness, that was worth the price of admission right there for something that nobody else is talking about. So thank you for bringing that knowledge and expertise. And I know where to be looking for deals. I was of two minds on it. It's like, you, as an investor, you want to get an amazing deal, but you also have to find people who are going through terrible things.